First off, I'm going to do a presentation on where I think things are at right now. I'd love to tell you that I'm about to give you a bunch of simple pat answers to everything, but the truth of the matter is, as my title slide implies, we're in an inflection point right now and what looks like a pretty big one. So things are going to be probably volatile for a while here. There's essentially a new trend coming out of COVID, coming out of 2020 that was, of course, a shit show for everybody. That trend is still in the process of being established, and it's not yet clear to me, at least. Plenty of other people think they've got it nailed down, but I don't yet think we know exactly how this is going to play out. And until we do, you got to expect a fair amount of volatility in both directions. It's mainly been in the wrong direction if you're a gold stock trader lately. And we may have a little bit more pain, but I think we are going to come out of that on the right side and possibly with a very long bull run later. And I'm a lot more comfortable about base metals. They're less affected by some of the things that are affecting gold right now. Essentially, pick your poison. I mean, I can make an argument for reflation. I can make an argument for inflation, deflation, stagflation. I wouldn't have a lot of trouble building a case for any of those things right now. And any of those things could be the outcome. I mean, certainly right now in the markets themselves, traders are trading the reflation trade. The argument's fairly simple, and I don't disagree. It's compelling. I mean, essentially, we're coming out of this, COVID crash, the worst economic dip, short-lived though it was, probably in history. There's a huge amount of stimulus about to be injected after two earlier rounds of stimulus in the US. And Canada, Australia, Europe, they're all doing the same thing. All the central banks are throwing money at the economy because they're worried about ensuring we do come out of this in one piece. What that's going to do, assuming everything goes smoothly across the G7 with vaccinations and opening up and COVID restrictions getting lifted, most economists are expecting growth rates this year, nominal growth rates, that is, in the 7, 8, 9% range, the kind of numbers we haven't seen for 50 years probably. Crazy high numbers. So not surprisingly, the winning argument right now is reflation, inflation. People are assuming that we're going to see this big inflation spike. A lot of people are sort of saying to themselves, the economy is almost back to normal. So if they throw another couple of trillion at it now, it can't help but drive up inflation. There's arguments against that, and I'm going to walk through this a little bit. But the main thing to keep in mind is, right now, it's still a little bit uncertain whether the rise in yields that we've seen, and while it doesn't look big when you look at a long-term chart, in percentage terms, it's a pretty big increase in yields over the last couple of months. We still don't know, or at least I don't, whether those yields have been rising for the right reason. In other words, they're rising because there's higher growth that'll generate higher inflation, higher demand for loans, higher demand for money. So money, the price of money, if you will, increases. Interest rates. I mean, that's fine if that's the reason. There'll be a little bit of push and pull at the start, but everything will be fine in the longer run. The other, potential wrong reason why bond traders have been selling bonds, which is why their yields have gone up, is they might be worried about, one, just more supply, and for that matter, oversupply of bonds. I mean, there's another, if it passes the Senate, there's another 2 trillion coming in the US. That's a lot of bonds. That's a lot of supply that the market's going to have to absorb. I don't think it's a coincidence that when 10-year rates spiked last Thursday, that was also the day that there was a 7-year note auction that day. And although the yield didn't rise that much on the note, it was in fact, by bond market standards, a very unsuccessful auction. The bid to cover ratio was about 2, which sounds great if you're doing a private placement for stock, but for the bond market, a bid to cover ratio, bids twice the size of the auction, is actually a terrible ratio. That's the worst since they started actually keeping track of this a couple of decades ago. I think that freaked bond traders out a little bit. Everybody seems to have calmed down. Things have dropped back from 1.6 to 1.4, but still, like I said, I just don't know yet whether, which of the 2 reasons it is. I think it's probably the right reason, in which case, we're all going to be a lot happier in a few months. but I can't discount it being the wrong reason and that the bond market's simply going to get choked with the amount of paper that it has to swallow in the next little while. And before I talk about gold specifically, and this applies to base metals too, I just want to talk for a minute on the interplay between inflation, gold, and metals, because they react slightly differently to them. Inflation is usually good across the board for base and precious metals, and in fact all commodities. But the relationship isn't that straightforward. It's a little bit different with gold. It's a little bit different with base metals. You know, inflation is driven by demand. In other words, like a high growth period. You know, say there's 8 or 9%. You know, I expect that to be a blip, but say we go into this magical period where the growth rate's 3 or 4 or 5%, which we haven't seen for a long time. On the unlikely event that happens, that tends to be very positive for base metals for sure, because you're just seeing straight up demand increases. Miners have trouble keeping up with it. That's when you get these periods. You know, think back to the 2000s when China was buying everything in sight, and all base metals had a very long and strong run. And in fact, they ran longer than the equity markets did. Base metals actually topped out after Wall Street did. Inflation, if it's driven by currency debasement, that's a much more positive for precious metals. I mean, it doesn't hurt base metals much because they get priced in US dollars. So if it's the US dollar as a currency being debased, at least on a nominal basis, they should see price increases too. But you'd see much bigger price increases for gold and silver. And you know, usually for gold, and I've said this over and over again a billion times, you know, real interest rates are what matters, inflation-adjusted interest rates. And the more negative they are, the further behind the curve the central bank is, the better it is for the gold market. And it usually doesn't hurt. It usually doesn't hurt base metals either, because in that situation, the Fed or other central banks is effectively being very accommodative, and that tends to push nominal growth higher. But it's especially good for gold. And really, when you get those kind of periods, it's not uncommon that they will be accompanied by currency debasement, intentional or not. If a central bank is running behind the curve, is effectively running a negative interest rate environment for 2, 3, 4, 5 years, it's that currency is likely to get sold during that period. Again, you saw that during the 2000s when gold had that long, beautiful bull market. The US dollar was pretty ugly through most of that period and actually saw pretty big decreases. And the other thing, of course, for base metals, this applies to gold too, but more to base metals where there isn't as much above ground inventory as there is with, say, gold or silver. You know, mining is hard. Mining deposits is hard. Timelines to put them into production, get through permitting, just get longer and longer and longer every year. The simple truth is, if we do have this, you know, elevated demand and elevated growth in demand for the next several years, it's going to be very, very hard for the mining sector to keep up with that. Even some metals that have higher warehouse inventories now, you'll see those get drawn down, and you'll probably see everything move higher over the course of the next 2 or 3 or 4 years if the base metal demand story turns out to be true, and so far it has been. Now, to give you a sense of how these things work sort of against each other, there's 2 charts on the bottom of the slide. The purple on the left, on your left hand, and the yellow on your right hand is actually, it's sort of the same thing on different time scales. It's basically the 10-year yield. You can see on the left hand chart how 10-year yields really started dropping, basically coming into 2019 when the Fed backed off any talk of tapering, started getting very dovish, cut rates right down to 0. Then of course it really dropped here in 2000 when the US Fed just dumped mountains and mountains of paper on the market and just tried to flood the markets with liquidity. The relationship is a little different and a little more interesting. This yellow line here, this is real yields, in other words, inflation adjusted. Not surprisingly, they kind of came down through that whole period as well, but they bottomed a little bit later, and they basically stayed down pretty much from when COVID really hit and we had the COVID crash until really just a few weeks ago. negative yields kind of stayed in the same range, kind of more or less negative a percent. You can see there's a fairly big jump here just in the last month. And if you're wondering why gold's been trading particularly badly in the last little while, that's really your answer there. In my mind, is that spike higher in yield, negative in real yields. The interesting thing in this chart on this, the one on the right side, the purple line is the copper gold price ratio. So it's basically just the ratio of a ton of copper to an ounce of gold. And again, that dropped through most of this, and that was because the gold price was going up on the back of all of the Fed dovishness, and then coming out of the COVID crash. Copper, not surprisingly, got knocked back when it looked like everything was slowing down, and then when everything just went in the garbage can during the COVID crash. But as you can see, this ratio has climbed very substantially, really ever since the COVID crash. But the big move has been in the last month and a half or so, pretty much since the start of the year. The copper to gold ratio has gone from like 3.8 to like 5.5. It's dropped back a little bit in the last few days, but that shows you probably the reflation trade. If you want proof of reflation trade, that copper gold ratio is probably it. That's buyers saying there's going to be high demand because of economic growth. Maybe there's going to be problems in supply because of COVID or because the miners just can't keep up. But you've seen base metals really take center stage during that period, and that's why that ratio has moved up so much. And just to give you a simpler, shorter term view of gold by itself, along with the 10-year yields, and these are not real yields, these are nominal yields. But you can see again how there is, as we all recall, I'm sure, how yields just dropped like a rock as things slowed down, and then we went into COVID, and everybody realized how serious that was going to be. They didn't really start getting any traction until late last year, and they lifted a fair amount from the start of this year. Not surprisingly, the peak in the gold price was just about where the bottom was in the 10-year yield. I just want to point this out because this is something I harp on and not everybody does. But the inverse relationship it's pretty obvious on this chart. You really can't miss it. If you want to know why gold is doing something weird on a given day, half the time checking the 10-year yield chart is going to answer the question for you. And we can't really, we can't blame gold trading lousy lately on the dollar. The U.S. dollar. This is just an index that's set to 100 at the start of 2000. The dollar had this spike, and this spike's a little bit fake because it mainly happened in a shorter period, where the U.S. dollar index spiked up to 106 when everybody was panicking during the COVID crash. But that, it soon turned around. It's been on a downtime pretty much since. We've seen a bit of a bounce kind of since the start of December, but it's really not. It's not an impressive bounce. I mean, let's be honest. I mean, the dollar index has come up maybe 1%. These other two lines here are the consumer and the PPI commodities indexes, and I think these are important because they partially back up my They partially back up my indecision about the reflation story. Yes, obviously there was a dip when everything crashed. Yes, we've seen these things both moving up, but really, when you look at where they are now in relation to the start of 2020, it's not much of a move. Like, yes, it's an increase, but it's not much of an increase. So I'm not yet sold completely on the inflation story. Where we will or should at least get a move, and hopefully this is going to help everything, especially gold, is in the next couple of months. If you realize how these statistics get created, generally monthly you see CPI, PPI. There's several inflation measures that get generated and reported every year. They generally get reported in two ways: month over month and year over year. Going into March and April, especially of last year, May too, but March and April especially, last year, everything fell off a cliff. Basically, we saw huge drops in supply. Markets froze up. Price of everything dropped. I mean, think about oil last year, which essentially went negative in Q2. So when we move into March and April and we start seeing these month over month, but more importantly, year over year comparisons, we should see CPI and PPI especially spike in the next 2 months. I don't know yet how big a spike it's going to be. Everybody knows it's kind of fake news, so I'm assuming that economists are going to try to find some way to massage a number a little bit because it will be a little bit fake, but nonetheless, the official numbers, and that seems to be what's driving the bond market. It seems to be what's driving the gold market. The real numbers, not what people think they are, or guys that say we actually have 200% inflation. That's just not what's driving the market. The market runs on the official numbers. Those official numbers, I wouldn't be shocked to see CPI and PPI jump to 2.5%, 3% in the next couple of months. And like I said, a lot of that's going to be fake, but that's what the number is going to be, the number. So if there's anybody out there trading on that, they're basically going to see real interest rates dive. I'm hoping that's going to give us a bit of a reprieve in the gold market. It's probably going to goose base metals too. The real question is what happens after that. Once that base effect passes and we're basically back to, okay, what's the real economy actually doing right now? What are prices actually doing right now? That's when we're really going to see whether we're starting a new long-term inflation trend. The short term is just going to be a lot of noise. And I'm telling you this mainly just to keep an eye on it because things are going to be a little nuts in the next couple of months because of base effects mainly. Normally, when the market starts worrying about inflation and bond traders start worrying about the Fed increasing things, the yield curve steepens. And when I say the yield curve steepens, basically what that means, if you think of short-term rates here, long-term rates there, if they sort of shift this way and the long-term rates tend to have the biggest moves, they're much more sensitive to these sort of things. Essentially, the curve steepens. You think about a line going from flat, let's say 45 degrees. Now, if you look at this chart, and this is a 10-year gold chart, there's three periods. The mother of all steepenings was right here, the taper tantrum, as they called it in 2013. I'm sure all of us have probably still wake up screaming thinking about 2013. Gold, not to put, excuse my French, shit the bed, completely fell apart. That was pretty much the end of the last resource, the last gas with the resource cycle, and things were dead for 5 years, as I'm sure you all recall. We had sort of, I would call sort of miniature versions of it, sort of late in 2016. And then in 2018, this was sort of the most recent version of the taper tantrum, as it's called, when the Fed was talking about cutting back on QE and maybe raising rates. And, you know, the equity markets weren't any happier about it than the gold market was. But I'm focusing on gold here. What I don't know is whether this latest one that I've circled is actually a taper tantrum. I mean, it's sort of acting like one. That doesn't mean that we will, in fact, get the taper. That's the real question: is what happens 2 and 3 and 8 months out? You know, does the Fed actually start tapering, or are they painted into a corner? On the other hand, if the reflationistas are right, and we do have this slowly rising trend of inflation getting, you know, creeping up, getting a little bit higher and a little bit higher, and the Fed is not in a position to get ahead of the curve, and I absolutely don't think they can get ahead of the curve. Even the current curve, I don't think they can do. If the Fed move rates to 2%, the equity markets would blow up, period, and they know it. The good news is that we are entering one of those periods. Gold loves that when you have a slowly rising inflation rate and the Fed chooses to be behind the curve. This is basically 2002 to 2012. This is the last big gold bull market. And really, you can explain a lot of this bull market with one, you know, really negative real rates through almost all this period. Yes, you had debasement of the US dollar, but it was being debased because of the negative rates, because the currency essentially wasn't a good buy in terms of expected returns because of negative interest rates. Moving to base metals, I'm not going to spend much time on them. I mean, we all kind of know what the story is. This is a pretty nice copper chart. I can't really complain about this. You know, obviously the other nickel is not that much different from this one. Lead, zinc aren't quite as impressive, but they all look quite good, and they're all at essentially multi-year highs. This is definitely reflation trade stuff, but it's also the appreciation of the fact that we appear to truly be moving into this electrification of everything period that guys in the battery space have talked about for years, but it's really becoming a lot more official now. It's becoming a lot more mandated across most of the big economies. That's going to create, you know, I don't know what the actual numbers are. I don't think anyone does, but for copper, for instance, let's say an extra it might be an extra 2 or 3% demand growth a year for a few years. That probably doesn't sound like much, but for metals, that's a really, really big deal. Trying to add an extra even 2% of supply every year on top of what's already in the pipeline would be extremely difficult for miners. You know, think about how long it takes to drill out a deposit once you find one. Think about how long it takes to permit one. It takes years virtually everywhere. So there's, although I think, you know, you got to be wary of periods where we might have recessions, because they're pro-cyclical, so base metals get sold hard in recessions, but the long-term picture looks pretty rosy for base metals right now. It looks like this is, in fact, the start of a very long trend. One thing on the equity side that I want to make note of, and this feeds back into the, you know, the indecision and the way bond yields are jumping around, bonds themselves are jumping around. If you look at these three, there's three things overlaying here. The top one is just the yield curve. That basically how steep it is. The higher the black line is, the steeper the yield curve is. The red one is the MOVE index, and the MOVE index is essentially the volatility index for bonds. VIX, I'm sure you've all heard of it. VIX is just volatility index for equities. You know, there's nothing big here right now. I mean, obviously the big jump on both of these. This was the COVID crash. You're seeing this big spike here towards the right side, but we are seeing both of these starting to climb again. You know, nothing big and scary. 27 is a bit high on VIX, but really not a big deal. But it's something we have to keep an eye on, because with all the indecision and with the way we're going to see swings and things like CPI and PPI, we could see both volatility and MOVE increase substantially over the next couple of months. And that's a big problem for the investment banks. It's a big problem for the funds, because volatility, and whether you're a bond fund or an equity fund, those volatility indexes get fed into the value at risk models that all of them use. And those value at risk models are pretty much sacrosanct. If those move too much and it squeezes a value at risk model too much, those guys have to sell. It's not an if, and, or maybe. They basically have to sell. So there is potential that we could see some real pullbacks on equity as this volatility keeps going up. Essentially, the higher the volatility gets, the more guaranteed it is that even on both the equity and bond side, that they essentially have to sell. It's not even a choice. They basically have to. So just to wrap it all up quickly, because as always, I'm over time. Sorry, Matt. Gold, it's going to be interesting till we get established trend. And when I say interesting, I mean that in the Chinese curse sense of the word. Having 5,000 years of history really gives you the perspective that when you say something is going to be interesting, you usually mean it as a curse, not a blessing. If the Fed really stepped up, as some people seem to be worrying about, and started trying to drain liquidity, which is just negative QE, if you will, quantitative tightening, and or raise rates, then we've definitely got a problem on the gold side, and it's probably not going to be great on the equity and base metal side either. I don't think that's going to happen. The Fed is very, very well aware that liquidity is the main driver of everything really right now. And yes, you can bitch and moan about it. You can wag your finger. You can say how horrible that is, and we have to go back to the good old days, whatever they were. But the truth of the matter is, the Fed's painted into a corner, and they didn't completely paint themselves into it. But there's no easy way out for them. I don't know what they're going to do. I know there was comments this morning from Powell saying he's going to give everybody tons of notice. He's in no hurry to drain liquidity. I really don't know what happens when they try to do that. Personally, I think odds are fairly high we'll see a market crash when they try it. So that's definitely something you got to keep an eye on. The volatility will stay high, but you know, I don't think the market's going to go crazy based on the spikes we see in the next month or two. Everybody understands that they're kind of fake news, but it's really what happens once those spikes pass. But during that period, we should see, at least on paper, pretty big negative interest rates. So that may give us a reprieve on gold here in the short term. Base metals, I just think we're in the early part of a bull market. The biggest danger is in fact that we get that crash I just talked about, and that gives us a recession and everything gets sold. Outside of that, I think the trends, you know, lower left to upper right for probably quite a while here. I think this is a new secular bull market. And, you know, whenever things are this uncertain, in my experience at least, I find that discovery stories and turnaround stories still do well. I mean, obviously the discovery have to work, they have to find something, but if they do, they have their own momentum and they can do well even when everything else is all over the map. Obviously, they would do better if everything was perfect and rosy, but I like those stories and periods like that, and that's why I have the lineup of companies that I have following me.